Listen, before you scroll, let me hit you with the one question nobody wants to answer out loud. What happens when the world needs silver right now, but the silver being traded is mostly promises on a screen? Because today, while everyone is staring at headlines and chasing the next hot ticker, something quieter is tightening like a noose. The physical side of this market, the stuff you can actually hold, is getting harder to guarantee. In real talk, mere YouTube stats show most of you watching right now aren't subscribed. If you value my work, subscribe and drop a quick comment, even if it's just "Our John AG," so the algorithm knows you're with me. Now, here's why I'm opening this aggressively. When a market is small, it doesn't take everybody to move it. It takes a few decision makers and a lot of panic. The silver market is tiny compared to bonds, equities, even compared to gold. So when the pressure starts building, it doesn't release politely, it snaps. In this video, I'm going to walk you through what a veteran precious metals analyst told me about the silver squeeze that's forming beneath the surface, what the East versus West pricing gap is really whispering, why delivery requests are spiking, and how rules can change overnight when the wrong side of the trade starts bleeding. Then we'll zoom out to gold, because if you think this is only a silver story, you're missing the bigger plot. We'll talk about why gold has been acting like the adult in the room, why big money is finally admitting they should have had it, and why something has to happen with global debt, whether governments want it or not. And just before we dive in, quick note, if you want daily updates, instant posts, and my personal analysis that I don't always share on YouTube, plus quick voice notes when something breaks, join my WhatsApp channel. Link is in the description. It's premium level stuff and it moves fast. All right, let's get into it. The core problem with silver isn't new. It's been building for years. For roughly the last 4 to 5 years, the amount of silver coming out of mines hasn't been enough to satisfy industrial demand. Not investment demand, industrial demand, the kind of demand that doesn't care about your chart patterns, your Fibonacci levels, or your feelings. We're talking electronics, solar panels, automotive systems, all the modern world parts that quietly require silver to function. And here's the part that most people misunderstand. Silver mine supply doesn't respond quickly to price. It's not like a meme coin where supply can be minted overnight. In the real world, most silver is produced as a byproduct of other metals. So if copper mines slow down or zinc projects stall, silver gets dragged with them. Plus, bringing a primary silver mine online can take 5 to 10 years. That means supply is sticky, slow, almost stubborn. So you get this weird setup. Industrial demand keeps rising, especially with technology and energy infrastructure, while supply stays relatively flat, sometimes even slipping. For a while, that gap gets filled by above-ground silver, the old stock, the stuff that's been sitting for decades in vaults, in inventories in hands that were waiting for the right price. And when price starts to rise, some of that silver does come out. The first wave is the weak holders, the paper hands, the folks who see a small jump and say, "I'm taking my profit, I'm out." But then something changes. As price climbs higher, the remaining holders tend to be the ones who didn't sell at the first jump, the sticky hands. The diamond hands? The people who aren't impressed by a $5 move and aren't tempted by a $20 move either. And once the supply migrates into those hands, it doesn't flow back easily. This is where the story gets dangerous for industrial buyers. Because for an electronics manufacturer, silver is usually a tiny fraction of total cost. Same with a solar producer, same with a vehicle production line. But if they can't get it, the entire line stops. And if the line stops, the losses aren't a little. They're catastrophic. So industrial buyers become price insensitive. They're not asking, how cheap can we get it? They're asking, can we get it at all? And that shift right there is how shortages go from rumor to stampede. Think about the psychology. Even if you're not sure a shortage is real, if you're a buyer who must have silver, you don't want to be last in the queue. You'd rather overpay than be shut down. So you buy earlier, you buy more, you pre-buy, you lock supply, and suddenly the market isn't just dealing with demand, it's dealing with fear-based demand. Now, an obvious question comes up. Do industrial players start going direct to miners? Do we see takeoff agreements, forward purchases, or even quasi-royalty deals where a manufacturer funds production in exchange for guaranteed metal? Yes, those conversations can happen. They're not fantasy. If you're a major consumer, you might call a big producer and say, "Let's make a deal, we'll finance something. You give us a slice of future output." But even that guarantee isn't perfect. Mines are in jurisdictions. Supply chains have politics, permits can get frozen, energy can get disrupted, strikes happen. And if you're relying on one source, you're playing Russian roulette with your production line. So the logical move is diversification, multiple sources, multiple regions, multiple agreements. Now, another question, if silver gets too expensive, do companies switch to alternatives? You've probably heard whispers already. Some manufacturers are experimenting with substitutions, especially in high volume sectors like solar, but switching isn't easy. Changing materials often means redesigning processes, retooling equipment, rewriting quality controls, recertifying products. It's expensive, slow, and risky. So substitution tends to happen only when the pain becomes unbearable or when the alternative becomes good enough at scale. And even if substitution reduces some industrial demand, we have to talk about the other engine that can overwhelm that reduction, investment demand. Because while factories chase supply for survival, investors chase silver for protection. Let's be honest, the world is saturated with currency risk, debt risk, political risk, payment system risk. People are increasingly uncomfortable with the idea that their wealth exists only inside a financial system they don't control. And that's why more people want an asset outside that system. Not a number in an app, not a promise, something tangible. I've been hearing the same story from multiple physical dealers across different regions. Demand is heavy. Sometimes it's the heaviest they've seen. Not just online orders, real conversations, real urgency, people asking, how do I store it? How do I buy it? What size makes sense? Coins or bars? Home storage or vault? And if gold starts feeling too expensive for the regular person, guess what's still within reach? Silver. That's how you get a wave. Not one big institution. A million smaller decisions, each one motivated by the same gut feeling. I don't trust what's coming. Now here's where the plot thickens. Because silver isn't just one global price. There's a paper market and there's a physical market. And sometimes they behave like two separate animals. Here's the simplest way to understand that split. The paper market is built for speed. It's built for leverage. It's built for people who want exposure without touching a heavy box of metal. So you get futures, options, swaps, pooled accounts, unallocated accounts, synthetic products, and a whole jungle of silver that is really just a claim on silver. And most of the time that works because most of the time nobody asks the awkward question, if everyone who owns silver exposure asked for actual silver, how many would get it? That's not a conspiracy question, it's a plumbing question. If you've ever looked at how these systems function, you'll notice a pattern. The same ounce can be referenced in more than one place. A bar can sit in a vault, be pledged as collateral, be the underlying for a product, and be part of an inventory report, all while the market trades paper claims against it at multiples of the physical quantity. That doesn't automatically mean fraud. It means the system is optimized for liquidity, not for mass delivery. But the moment delivery becomes popular, that optimization becomes a weakness, because paper traders can be settled in cash. Paper can be rolled, paper can be closed out with a button. Physical can't be created with a button. Physical has to be refined, transported, insured, audited, stored, and, this is the key, released by someone who is willing to part with it. And that's why, when the physical market tightens, you'll often see something that looks illogical to casual observers. Paper price can hesitate, but physical premiums can explode. Or physical can trade at a persistent premium in certain regions, refusing to obey the paper quote. That's not magic. That's two different markets expressing two different realities. And if you've never experienced a supply squeeze in real life, it's hard to grasp how quickly it changes behavior. A dealer who could supply you next week suddenly says, maybe next month. A manufacturer who used to order casually suddenly signs longer contracts. A buyer who used to price shop suddenly says, just lock it in. And here's the cliffhanger. The last stage of a squeeze isn't when everyone wants silver. It's when the people who must have silver start competing with the people who are hoarding silver. That's when something breaks. So when I say the paper market and the physical market can behave like two separate animals, I'm not being poetic. I'm describing what happens when availability becomes the real price driver. Now keep that in mind as we talk about the East-West gap, because that gap is basically the market shouting availability is not the same everywhere. Recently, the gap between prices in the West, where paper trading dominates, and prices in the East, where physical demand often expresses itself differently, has been widening in a way that makes professionals sit up. Normally, that gap is small, maybe 50 cents, maybe $1, maybe $1.50 in extreme moments. But when you start seeing gaps of $5, $6, $8, even close to $10, your brain should immediately ask, why isn't it being arbitraged away? Because in theory, if you can buy cheaper in one market and sell higher in another, smart money rushes in, ships metal, closes the gap, and pockets the spread. So if the gap keeps widening, one of two things is true. Either the arbitrage isn't allowed, or the physical metal isn't available in the quantities needed to do it. Let that sink in. If big players with logistics and financing aren't flooding the higher priced market with metal to capture that spread, it suggests they can't, or they won't, because the metal isn't as accessible as it looks on paper. And that leads to another signal. Deliveries. Now, a lot of people hear delivery and imagine a forklift rolling up with a mountain of bars like it's an action movie. But delivery stress often shows up in boring places first: inventory categories, vault reports, and the difference between metal that exists and metal that is actually available for delivery. Because not every ounce reported in a vault is freely deliverable. Some metal is simply stored. It belongs to someone. It's sitting there as a service. That metal might be counted as present, but it's not part of the pool that can satisfy contract deliveries unless the owner decides to release it. Then there's the metal that is specifically designated for delivery. Metal that can actually be used to settle obligations in the way the contract describes. If the deliverable pool shrinks while delivery requests grow, the market gets a headache. And what happens next is predictable. The system tries to discourage delivery without openly saying, please don't ask for delivery. How? It can happen through rising premiums in the real world while paper stays calmer. It can happen through rule adjustments that make delivery more expensive or more complicated. It can happen through incentives to take cash instead. And it can happen through delays that are technically allowed but psychologically revealing. If you're a participant and you start hearing, sure, you can have the metal, just not on the timeline you expected, you'll quickly learn the difference between a liquid promise and a scarce resource. And that's why delivery trends matter even if we don't know the names behind them. Delivery is the moment the system is forced to prove it can turn paper into metal on demand. If it can, great. If it can't, the next step is where things get spicy, because then the market has to decide whether price is going to rise enough to shake metal loose, or whether rules are going to change to protect stability. And ask yourself honestly, in a true shortage, which option do institutions prefer? Higher prices that embarrass the system, or rule changes that preserve the system's appearance? That question is the one nobody wants to answer until the day it matters. In the futures world, most contracts don't end with someone taking metal. They roll, they settle financially. It's paperwork, it's exposure, it's a position. But when more and more participants start saying, no, I'll take delivery, the system feels it. Because the system is built on the assumption that most people won't demand the physical. When delivery requests start hitting record levels, month after month, something changes. Pressure concentrates at the point where promises must become reality. And here's the uncomfortable truth. We often don't know exactly who is demanding delivery. We don't get a press release that says, hello, it's Company X, and we're taking 10,000 contracts worth of metal. That information isn't public in the clean way people want, but the pattern matters. If deliveries are multiple times higher than prior years and accelerating, that's not random. That's not noise. It reminds you of historical moments when a few players decided they wanted the real thing, not the paper. And the market panicked because it wasn't designed for that. Now at this point, people ask me, okay, John, if deliveries keep rising, what can the exchange do to keep things orderly? This is where you need to stay calm and think like the system. Exchanges have tools. They have circuit breakers. They can pause the market when price moves too fast. They can raise margin requirements. They can make rule tweaks that sound technical but change the game. And they've done it before. Margin requirement changes are especially powerful because they can force liquidation. If margin becomes a percentage of price rather than a fixed amount, then as the price rises, the collateral required rises too. That can squeeze shorts, yes, but it can also crush longs if the market whipsaws. It's a way to control velocity. And if things get truly disorderly, there's always the force majeure style outcomes. Cash settlement instead of metal, contract cancellations, emergency rule changes. People hate hearing that. They say, that can't happen. But we've watched versions of it happen in other commodity markets. Rules can be rewritten when the risk becomes existential for the wrong side of the trade. So if you're holding paper claims, you have to understand the game you're playing. You're relying on the system honoring the contract in the form you expect. Now, none of that means you should panic buy tomorrow morning with rent money. It means you should be realistic. And here's the big lever most people forget. The silver market is tiny relative to global pools of capital. If even a small percentage of bond money or equity money decides they want a fraction of a percent in silver, you can get a move that looks impossible. But big institutions don't move fast. They move slowly, through committees and compliance and custody and legal. And here's what that slow movement looks like behind closed doors. It's not one genius trader slamming a buy button. It's a meeting, then another meeting, then a spreadsheet, then a risk report, then a legal review, then a custody conversation that sounds boring until you realize it decides whether the metal is held in a place you trust or a place you merely hope is fine. Someone asks, do we want this as an ETF position, a futures position, or allocated physical? Someone else asks, if it's physical, whose vault, which country, and what are the audit rights? Compliance asks, how is this classified and what are the reporting implications? Risk asks, what happens in a squeeze if liquidity disappears? And the committee chair asks the real question, if this trade is right, what's our downside if we do nothing? And that last question is why these moves snowball. Because doing nothing becomes a risk in itself when the environment changes. Now, I want you to hold that image in your mind, because once a few big pools of capital decide they need some silver, the next pools of capital don't want to be the last ones through the door. They don't want to explain to clients why they ignored an asset that was screaming scarcity while they sat in assets that were quietly losing purchasing power. That's how you get the slow to fast transition. It's slow, right up until it isn't. And one more thing, if you want these behind-the-scenes shifts tracked daily, that's exactly why the WhatsApp channel exists. Link in the description. Join it because I post quick notes there the moment I see something important without waiting for the next upload. They have to decide, paper or physical, which custodian, which jurisdiction, which size bars, which reporting, which risk model, going from 0 to even 0. 25% allocation might take months, sometimes longer. That's why these moves tend to feel sudden to retail. Institutions may have been planning it quietly for a year, and then one day it shows up as flows. So if you're watching this thinking, is it too late? No, it's never too late to start building resilience. The smarter question is, how do you enter without losing your mind? If your goal is pure profit, you chase paper exposure. You trade, you try to time moves. But if your goal is protection, an asset outside the system, you approach it like insurance. You buy gradually, you get comfortable, you learn storage, you learn liquidity, you learn what you're actually holding. And let me make this practical, because a lot of people freeze right here. If you're starting from 0, the smartest move is usually not one giant purchase. It's building a ladder. Start with something recognizable, something liquid, something you could sell quickly if you ever had to. In many places, that means widely known 1-ounce coins or common small bars from reputable mints. Not because fancy collectibles are bad, but because in a tense moment, liquidity is king and familiarity sells. Then think about sizes. Small pieces are flexible. They're easier to trade. They're easier to use in a pinch, but the premium can be higher. Larger bars can reduce premium per ounce, but they're less flexible and they can be harder to move quickly. So a balanced approach often wins. Some smaller pieces for flexibility, some larger pieces for efficiency, only in amounts you're comfortable storing and protecting. And storage is not a side detail. It is the whole game. If you keep it at home, you need privacy, discipline, and a plan. If you store it professionally, you need to understand the terms, allocated versus unallocated, audit rights, redemption policies, jurisdictions, and how fast you can access or liquidate. And here's a trap I want you to avoid: buying physical with the mindset of flipping it next week. Physical is not a day trade tool. Physical is your outside the system sleeve. The thing you own when the internet is glitching, the banks are temporarily down, or the rules are suddenly rewritten. If you want to trade, use instruments built for trading. If you want insurance, treat it like insurance. Now, I'm not telling you what to buy. I'm telling you how to think so you don't get emotionally hijacked by price spikes and doom posts, because the goal here is not adrenaline. The goal is optionality. And in a crisis, silver coins can be uniquely useful, not because everyone cares about silver today, but because in a crisis, people learn fast. The same person who can't tell you the value of a 1-ounce coin today might know exactly what it's worth when trust breaks. So the premium you pay on physical, yes, it can be high. Yes, taxes exist in some places. But if you're buying it as an emergency tool rather than a weekly flip, you're paying for peace of mind, not for a quick trade. Now let's pivot to gold, because gold has been doing something important. It's been proving, mathematically, that it belongs in portfolios. We've seen a broad realization among wealth managers and large allocators. If you had held gold over the last several years, you would have improved long-term returns and reduced volatility. In professional terms, you improve the risk-adjusted return, the Sharpe ratio story. And once that math becomes undeniable, the conversation changes. You don't have to convince them gold is shiny. You just show them the portfolio outcomes, and suddenly, people who ignored gold for years start saying, we should have had it. Historically, some private banks used to allocate around 5% to gold as a default for clients, not because they were doomsday preppers, but because it worked. Today, many portfolios have far less than that. Some have almost none. So what happens as that number creeps up? It doesn't take a huge shift to create huge demand. And then you add central banks. Central banks have been accumulating gold, but here's a nuance people miss. The flow isn't always a dramatic dump treasuries, buy gold move. Often it's quieter. Bonds mature. Instead of rolling 100% back into the same paper, a portion quietly shifts into gold. It's rebalancing without a headline. Why? Because the weaponization of payment systems has changed how countries think. Nobody wants to wake up and discover their reserves are suddenly a political lever. So more countries, especially those that want strategic neutrality, prefer holding something that can't be frozen by a keystroke. And yes, that also connects to the future of money itself, because we are moving toward tighter control. Even if politicians say, we're not doing that, the infrastructure is being built. Digital currency frameworks, monitoring frameworks, frictionless taxation frameworks, the idea that money should be trackable, controllable, programmable. Now imagine a world where your spending must route through a monitored wallet, where there are limits, where transfers require permission once they cross thresholds, where speculation can be flagged, where capital controls become a feature, not a crisis tool. In that world, the old idea of, I have money, therefore I have freedom, breaks. You might have money, but not access, not permission, not mobility. And if that sounds far-fetched, let me ask you this. Do you really believe governments will watch debt costs spiral forever without reaching for every tool on the table? Because that's the other monster in this story, global debt. Debt growth isn't a small problem, it compounds. And as interest rates rise, refinancing becomes a trap. You're rolling old debt that was issued at near zero rates into new debt at much higher rates. The cost escalates. At some point, interest costs threaten to overwhelm tax revenues. Then something has to happen. Maybe it's inflation. Maybe it's restructuring. Maybe it's a quiet bail-in. Maybe it's capital controls. Maybe it's a new system layered on top of the old one. But the point is the same. The current path isn't sustainable. And this is why gold doesn't need a perfect narrative. It just needs the math of survival. Now, some people ask about a settlement currency idea, regional blocks, baskets, maybe partially backed by gold, whether that forces the West to remonetize gold. I'm not seeing a clean political appetite in many Western countries to return to a formal gold standard, not because gold doesn't work, but because control is addictive. Printing is convenient, flexibility is power, but I do think we'll see parallel systems, settlement mechanisms between nations, where gold plays a role in clearing imbalances. Not necessarily a shiny gold coin standard, but a gold-informed mechanism where deficits and surpluses ultimately anchor to something real. And in that environment, gold continues to gain relevance as the neutral reserve asset. Now let's talk about the smaller cousins. Platinum group metals. These markets are tiny, smaller than silver in many ways. And when markets are that small, you don't need a flood of buyers. You need a drip of new allocation. A handful of players deciding, I want exposure. That's why these metals can move violently. Not always because of perfect fundamentals, but because of size. And then there's miners. For a long time, miners lagged. Gold rose, but mining equities didn't fully reflect it. Then the catch-up started. Here's the key concept. Miner profits can rise faster than the gold price because costs don't rise one for one instantly. If it costs a miner, say $2,000 to produce an ounce, and they sell at $3,000, that's a $1,000 profit. If gold rises to $4,000, their profit becomes $2,000. Gold rose 33%. Profits doubled. That leverage is real, and the market often reprices miners sharply when earnings prove it. Analysts update models, target prices change, bots and funds chase relative upside, and you can see sudden bursts in share prices right after results. But even if gold pulls back, miners can still remain highly profitable at elevated gold levels, which creates an interesting setup. Companies with strong cash flows potentially trading on low multiples, paying dividends, buying back shares, or acquiring resources. And yes, acquisitions matter. Mines are depleting assets. They are holes in the ground that shrink over time. Large miners must replace reserves. So in a high-price environment, it's rational for large companies to buy smaller developers who have ounces in the ground but lack the money to build. If you want to look for potential targets, one strategy is simple. Look for developers near existing producing mines. Geography matters. Infrastructure matters. It's easier to integrate a nearby project than one across the planet. But miners also have risks, especially geopolitical risk. Many mines are in less stable jurisdictions. The solution isn't to pretend that risk doesn't exist. The solution is diversification. Don't overload one country, one region, one political risk. Now, before we go further, let me do something important and creative right here. If you want silver-related success stories, real people, real journeys, and how they made money in this space, there's another channel linked in the description. Subscribe there too and binge a few stories, because seeing what's possible can shift your mindset fast. And speaking of success, if you're watching right now and you've had a win in your life, it doesn't even have to be silver, drop it in the comments. Seriously. Share your success so other people get motivated. Sometimes one person's story is the spark that keeps someone else going. Now, here's the cliffhanger moment you need to sit with. What happens if institutions slowly move toward even a tiny silver allocation? While industrial users are quietly trying to secure supply, while more traders demand delivery, and the East-West physical premium refuses to close? That's not one story. That's 3 stories stacking on top of each other. And stacked stories are how markets break. So what do you do as a regular person? You don't need to become a full-time metals trader. You don't need to go all in. You need a plan. A plan that assumes the system can change rules. A plan that assumes paper markets can behave differently than physical markets. A plan that respects the idea that scarcity isn't just about quantity. It's about willingness to sell. That's why I keep coming back to the concept of outside the system assets. It can be land, it can be tools, it can be durable goods, it can be precious metals, it can be a mix. But the mistake is thinking you can wait until the panic is obvious. By the time the crowd agrees, the best choices are already gone. Now let me ask you two questions, and I genuinely want you to answer in the comments. First, do you believe the East-West silver gap is a temporary glitch or a warning that physical tightness is real? Second, if governments roll out tighter digital controls, what asset do you trust the most to keep your options open? Drop your answers below. I read them, and they shape what I cover next. And one more thing. By the time you're watching this, I've already published a members-only video that bundles the latest updates in one place. If you want the in-depth layer, the stuff I don't always put in the public video, join the membership and watch that members-only upload. It also shows me who's really following. Now, I want to pull the lens back one more time because the silver story, the gold story, the debt story, and the digital control story are not separate. They're chapters of the same book. The book is about trust. Trust in currencies, trust in institutions, trust in the promise that your money is yours, trust that contracts will be honored as written, trust that the rules won't change when the wrong players are losing. And every time that trust gets questioned, hard assets become more attractive, not because people love metal, but because people hate uncertainty. So when I say something has to happen, I'm not trying to scare you. I'm describing the math of debt. You can't compound liabilities faster than the productive economy forever. Eventually, you either devalue the liabilities, restructure them, or reset the system around them. And resets are messy. They don't announce themselves politely. They arrive as emergencies, as temporary measures, as for your safety, as to protect the system. And once those measures arrive, they rarely leave. So if you're building a portfolio, think like a realist. Some growth, some cash management, some exposure to hard assets, some optionality, some redundancy, some resilience. And if you do look at miners, remember the basics. Leverage cuts both ways. Great upside, real risks, diversify. Understand jurisdictions, understand balance sheets, understand costs. Before we wrap, here are the 3 signals I'm watching like a hawk, because they often move before the crowd understands what they mean. 1, physical premiums in your local market, not the headline spot price, your real-world buy price. If premiums refuse to come down even when the screen price cools, that's the market telling you supply is tight where it matters. 2, delivery behavior. When more participants insist on taking metal instead of rolling paper, it's a stress test. If that trend accelerates, it forces the system to respond, either with higher prices to coax metal out or with tighter rules to slow the demand. 3, policy language. Watch how officials talk about stability, speculation, and temporary safeguards. Those words are often the runway for restrictions because nobody sells you control directly. They sell it as safety. And here's the cliffhanger. If all 3 of these signals rise together, premiums, deliveries, and control language, you're not watching a normal bull market, you're watching a transition. That's when decisions made quietly in boardrooms and central banks hit the street all at once. So keep your eyes open. Now, to wrap this up, I'll leave you with the most important practical takeaway. If your entire financial life depends on the system working perfectly, you're betting on perfection in a world that doesn't offer it. So build a little insurance. Build it steadily. Build it wisely. And if you want my daily updates, don't forget the WhatsApp channel link in the description. Join it today, because when markets move fast, waiting for the next upload is like reading yesterday's weather report. And if you're already winning, business, job, investing, anything, don't stay silent. Your comment might be the push someone else needs today. Share one lesson, one mistake, or one win. Community is a moat, and we build it together right here, right now, for real. Finally, subscribe to the channel, hit the like button, and comment Arjan AG if you want to support my campaign to eliminate copycat channels and prove to the algorithm that original work matters. And tell me in the comments, are you more worried about a silver supply crunch or about the rule changes that could happen when it finally gets exposed? I'll see you in the next video.